Blan partners. We will be running this program using the agenda. Okay. So the program will be run using the agenda. It's not being displayed on the screen, but essentially, we would be having an opening remarks session by our president, John Bosco Uche. And after that presentation will be delivered by Ozioma Agu. And before that, we would have a citation to be read by Mr. Ibrahim Dong. After that, Ozioma will come up with her presentation, which will be in two parts. The detail will be shared in the course of the program. After the presentations, we would have a Q&A session that will be moderated by Mr. Dong. This would then be followed by any comments from the Stren and Blan partner representative here. And then we would have a closing remarks session by our president, John Bosco Uche. So I'll hand it over now to the president to come up and give us his opening.
Okay, thank you very much, our Publicity Secretary, Somime Oguntola, and good morning, ladies and gentlemen, and really welcome to this very special webinar that we are holding on the very first day of the month of April, and again, the very first day of Q2. I am actually quite excited that we're able to get this webinar. As you know, our ideas continue to find oil and gas, but while we continue to focus on our professional development and driving the technical delivery of our work, we thought that it's equally important to be able to bring some other valuable topics to our members and our friends and associates. This time around, expanding it into beyond technical, touching commercial, business, finance, but also, most importantly, some of the topic that you're going to be hearing today around tax and incentives and community development. I know we've been having a bit of discussion with Stren and Blan partners, a key partner who is going to be speaking to us today, Ozioma Agu, on the best way to be able to bring value to our members. And I'm quite excited that they accepted to show up today and provide an insightful discussion that will be beneficial to our members as we continue to do our work in the oil and gas industry, while looking into the future of the energy that we continue to drive for excellence. I am actually looking forward that it's going to be quite insightful. As the PS mentioned, for the next 15 minutes, I want to urge you to really relax and listen to the presentation and, of course, participate actively in the Q&A. Our drive is to continue to provide the platform for this kind of sharing of knowledge, because we need to, in my mind, really understand the environment that we play in, around the business environment, around the government policies and regulations that are available, which we have to operate within. And I'm quite excited that Ozioma Agu is going to be doing justice to that this morning into the afternoon, I believe. And I really want to call on every one of you to really, really, really relax for the next an hour and a half for what I think is going to be promising to be quite insightful. But before I actually move on to the next agenda, I think I've got a couple of the executive committee members on the call, the vice president, the president-elect, and a few other executive committee members. I think it will be also quite good that the president-elect, just to, again, hear your voice as well before we go into this, just to, again, have another voice in the room before we move on. So our president-elect, Madam Jumoke Ajayi, if you just maybe one or few words as well before we hand the baton back to the Assistant Editor-in-Chief.
Thank you very much, my president. Thank you our presenter of today for making time to attend. Like the president said, this is really a topical one that will be very useful for us in the industry, especially the fact that we go into commercial, we talk about tax, and most importantly, the most community development funds under the PIA that is a new thing. It's new to many operators, and some of us have been, working on putting this together and getting it finalized. Issues before me and all that. It's making it a bit difficult. So for this type of webinar today, it's one that I believe is will be enriching and also guide the operators. So it's really about moving on forward to learning what to get into. Thank you very much for creating time. Good morning. What the answer to our thank you very much. We appreciate it. So I look forward to learning. So thank you.
Thank you. Thank you very much, President-elect. And on that note, I think I should be handing over back to the Assistant Editor-in-Chief, who, again, I want to say a big thank you to yourself as part of what you run for us in NAPE around, training activities. You've kind of related quite well with Stren and Blan to get us to this point to have this session today. So thanks again upfront, I must say. But on that note, I'll hand back to you to do the justice to introduce our special speaker for today. So over to you now, Lawrence.
Thank you, P. I am honored to do this on behalf of NAPE, and I will just dive into it without too much ado, okay? I looked forward to this personally after reading our speaker's profile, which I'm going to read to you now. And I'm looking forward to all the knowledge that will be shared on this call. So please listen. Ozioma is a partner at Stren and Blan Partners, leading the energy, finance, and instructor practice group. She has garnered years of experience advising on various aspects of banking and project financing, amounting to cumulatively $5 billion US dollars, involving Nigerian and foreign financing institutions. She has also export credit agencies. She has worked with government funds and the private sector as well. Ozioma exceptional advisory services cover secured and unsecured cross-border lending, project finance, syndicated lending, structured finance, and general corporate and commercial guidance, some of which have received global recognition. Her expertise also shines in the energy sector, particularly oil and gas and power. She has advised on significant deals, including the acquisition of a major IOCs in Nigeria, the financing of liquefied petroleum gas depots, and facilitating funding for key oil and gas companies. Ozioma is currently playing an instrumental role in the establishment of a state and private sector-led electricity market in eastern Nigeria. She has been a driving force behind advancing renewable energy initiative and has played a vital role in facilitating the growth of solar mini-grids projects aimed at ensuring electricity access for off-grid communities in Nigeria. Ozioma excels in infrastructure, advisory, and public-private partnership, PPP. She has recently advised a leading telecommunication provider in a headline PPP intervention road project with the federal government of Nigeria, which saw the implementation of the Road Infrastructure Tax Credit Scheme, RITC. She also acts as a lead advisor to an international client on the concessioning of a seaport in Libreville, Gabon, and is currently advising an indigenous client on the large-scale mining of tin and columbide in northern Nigeria. Her dedication and excellence have earned her numerous accolades, including IFLR recognition in 2021, 2022, 2023, 2024, the ESQ 40 Under 40 Awards, as well as recognition by the Legal 500 Directory. I was expecting a clap at this point, but anyway, we'll do that virtual clap later on. In 2024, Ozioma was honored as one of the 25 Under 40 Energy Women, Rising Star by the African Energy Chamber, celebrating her exceptional achievements. In Africa's energy industry, her expertise is a driving force in energy, finance, and infrastructure sectors, making her an invaluable asset to Stren and Blan partners and the clients she serves. Ozioma, thank you for doing this for us, and we look forward to tapping into your knowledge of experience in this session. I yield the mic to you.
Thank you very much for that, Ibrahim. Sometimes when I hear my bio being read, I always get shocked because I ask myself if this is me. So you have my team to blame for that. Okay, thank you very much, everyone, for making out time to be at this presentation, at today's webinar. I am truly honored and privileged to be sharing my time with you. I know today is a public holiday, so we're going to make it worth it. All right. I'm going to dive straight into it. So in 2024, the federal government issued an executive order, 3 executive orders in one, to basically incentivize activities in the oil and gas sector. We're going to be navigating, explaining, understanding, learning what these executive orders mean for operators in the oil and gas sector, for the members of NAPE especially. So with the executive order is a focus on tax incentives, and it has revised royalty structures, some corporate tax adjustment, as you're going to understand during the webinar, because some of the provisions of the order also affected the provisions of the 2020 Finance Act, and by extension, the Companies Income Tax Act. So what this fiscal framework does is to basically stimulate exploration and production, promote gas commercialization, and strengthen Nigeria's position in the global energy market. So the new tax credits, allowances, and exemptions are going to be divided into these 3 categories during this presentation. The number 1 is how these incentives impact your profitability, your investment structuring, and compliance obligations. And then also the eligibility criteria for NAG, that's the non-associated gas and midstream utilization incentives, and also practical insights on leveraging these benefits for your operational efficiency. Down in the presentation, I think someone just asked if there's a slide. Yes, there is a slide. So if you don't mind sharing the screen, Ibrahim, or your IT department, yes. So down in the presentation, we're going to also see some simulations, because I want this to be broken down in very easy way as much as possible. So you're going to be seeing practical example of how these things can affect you, and not just us rehearsing what the provisions of the law, provides for. So the first one is the Oil and Gas Companies Tax Incentives Exemption and Remission Order 2024. The second one is the implementation guidelines issued by the minister at the back of that oil and gas companies' tax incentives. The third one is the notice of tax incentives on deep offshore oil and gas production, the VAT modification order, and then the exemptions under the deduction of tax at source, that's your withholding regulations of 2024. As we navigate this presentation, you're going to see that it's actually a robust incentive framework that was provided for by the government, affecting the gas sector only, affecting greenfield and brownfield productions, affecting natural gas, affecting E&P, oil, that's your oil and gas exploration and production, which you are going to find out in the notice of tax incentive for deep offshore. Whereas the one on the gas commercialization, tax credit, and all of that applies to your onshore and shallow water assets. So it's really robust and it touches every relevant facet of the oil and gas sector. The first one, which is the oil and gas tax incentives exemption remission order 2024. The key highlights of the order. Number one is the tax credit for NAG greenfield development. So a gas tax credit was introduced in this order for NAG greenfield developments in onshore and shallow water locations, with first gas production required on or before 1st January 2029. I will also explain further when I get to the relevant section. There are also other provisions, other incentives that will apply to you even after 2029. However, there is going to be a little modification to the quantity of tax credit that you can get, to the amount that you can get after 2029. Now, your tax credit, your gas tax credit for a NAG greenfield development is tied to the amount of HCl in your production, in your extracted gas. That's your hydrocarbon liquids content. What the order provides for, as well as implementation guidelines, which I will talk about, is that when the HCl content is 30 barrels per million standard cubic feet, that's your SCF in short, or lower, then your tax credit will be $1 per 1,000 SCF, or 30% of the fiscal gas price, whichever is lower. Don't worry, as we go on, you will understand this better. Then when the HCl content is between 30 and 100 barrels per million SCF, then your tax credit will be 50 cents per 1,000 SCF, or 30% of the fiscal gas price, whichever is lower. Your fiscal gas price is determined by the rate of the royalties that you pay under the PIA. Then, for gas projects that begin production after January 1st, 2029, they will be eligible for a gas tax allowance, now no longer a gas tax credit. So get the difference. Before January 1st, 2029, you are eligible for a gas tax credit for production, exploration, extraction of gas with a hydrocarbon liquid content that is between 30 to 100 barrels. So depending on the amount between 30 and 100 barrels, if it's anything 30 barrels or less, you're going to get at least 30% of the fiscal gas price, or 50 cents, whichever one is lower. Now, if after 2029, if after January 1st, 2029, you have unclaimed gas tax credit, or you don't, or you begin your production after 2029, your tax credit will now transition into a gas tax allowance. When it becomes an allowance, it means that you can now claim it as a deductible in your yearly assessment when you're about to pay your income tax. So it's no longer a credit in the form of money that accrues to you. It's now a deductible. And it's going to be a deductible of 50 cents per 1,000 SCF, or 30% of the fiscal gas price, whichever is lower. But in all of this, the tying point is that at no point should your HCl content be more than 100 barrels per million SCF. So if it is more than 100 barrels per million SCF, you would not be eligible at all to claim, whether you're claiming it before 1st January 2029, or whether you're claiming it after. Your tax credit and your GTA under your oil and gas tax incentives order 2024, which is number one of the 4 orders that the president issued, is available for a maximum of 10 years. So after this period, it's going to convert into GTA. So your tax credit is available for a maximum of 10 years. And after 10 years, it converts to a GTA at the same rate. And the same rate is your 50 cents per 1,000 SCF, or 30%. If your HCl content is between 30 and 100 barrels, or if your HCl is 30 barrels per million standard cubic feet, then it's $1. So it's basically just half of it. You have $1 if it's 30 or less. If it's between 30 and 100, you have 50 cents. The logic, the principle is that the lesser your HCl, the lesser your hydrocarbon liquid content, the more credits you get. And that's the whole, the ultimate objective of the order, to encourage production of NAG, that's non-associated gas, in greenfield development. Now, the credit cannot exceed the company's income tax payable for the year. And that means if, for instance, all your tax, if you've done your assessment for the year for your company's income tax, as a case may be, and you're probably supposed to pay 50 million naira as your company's income tax, and then when your gas tax credit is calculated, it's above that, then you cannot take the surplus, because at no point in time should it be more than the company's income tax that you are paying for the year. And it can also be combined with incentives under the Associated Gas Framework Agreement for the same project. I will explain this as we go by. And then also, if a company does not fully utilize the tax credit in a year, the unused portion can be carried forward for 3 years only, maximum of 3 years. So that's like the summary and the highlights of the first order. And that is with respect to NAG greenfield development. Now, the second one as well, still under the oil and gas companies' tax incentives exemption remission, is the gas utilization investment allowance in the midstream oil and gas industry. Now, the first one that I talked about was for exploration and production of NAG. Now is your allowance in the midstream oil and gas sector. So if you remember at the beginning of this session, I had mentioned that the executive orders and the incentives that we're going to be exploring and discussing touch on almost every relevant value chain of the oil and gas sector, which is a deliberate action by the government to ensure that these sectors, these different operators and players in the value chain, are able to claim these incentives to make more robust production and carry on with their activities in their respective sectors. So the second one, which is the gas utilization investment allowance in the midstream oil and gas industry, provides for incentives for midstream oil and gas companies, granting a gas utilization investment allowance for qualifying expenditure on plant and equipment used in new and ongoing projects. And this is to encourage investment in midstream gas infrastructure. Companies can claim a gas utilization investment allowance for qualifying expenditure on plant and equipment used in new or ongoing midstream gas projects. Now, this is different from the first one, which is for your production of NAG, and for which you have a tax credit of either $1 or 50 cents, depending on whether you have 30 to 100 barrels per million SCF. Whereas this is for midstream, and what you are getting here is a utilization investment allowance. Now, if you were used to, if you under the company's income tax, there are provisions generally for companies where they can claim allowances as deductibles for qualifying expenditure, capital allowances for expenditure on plant and machinery, which has been purchased for the purpose of their business operation. So you ordinarily would be able to claim that for your yearly assessments, so that you can deduct it as part of your business or operational expense. What this does is to mirror that kind of arrangement, whereby operators in the midstream sectors are able to claim these allowance for their qualifying expenditure for purchasing plant and machinery. Now, the key features of this investment allowance is that it is 25% of your actual qualifying expenditure. So it can be more than 25% of your expenditure, that plant and machinery. It is deductible from your assessable profits in the year. The expenses incurred, just like you do your normal deductibles and allowances during your yearly assessments for payment of taxes. And then the allowance does not affect capital allowance claims on the same asset. I will explain this. Also, it is only claimable after any tax period under 39(1) of the CETA has ended. it's very important to understand how this works, because if you don't, you would think that it overlaps with the provisions of the Companies Income Tax Act, but they don't. And in fact, they make very clear distinctions between the CETA and this GUIA. The first one I'm going to be explaining is that first, it does not affect capital allowance claims on the same assets. Now, if you check your 39(1) of CETA, you have a capital allowance. You are able to claim a capital allowance under as a midstream oil and gas operator of about 35%. Now, this is, and also an investment allowance as well of about 90% with a 10% retention. Those have different criteria. Now, this GUIA does not affect that provision. And secondly, under 39(1) of your CETA, there's a new addition by the Finance Act of 2020 that specifically makes provisions for tax holiday for companies in the midstream oil and gas sector. Now, what this does is, because it does not want any overlapping, it says that you can only claim your utilization investment allowance under this executive order, right? And under the implementation guidelines issued by the minister and FRS, as the case may be. You can only claim that after your tax-free period under CETA has ended. Now, ideally, if you set up a midstream company or if you're engaged in midstream operations and everything, you are ordinarily entitled to what we call, generally, we use the general term pioneer status, which is 3 years first and then 2 years subsequently if it is renewed. So this provision says that you can claim your investment allowance as a midstream operator after your tax-free period in the CETA has expired. Now, there are clear conditions and exclusions that apply to people, to companies who want to claim these tax deductibles. The first one is that, so your company will lose this utilization allowance if you fall into any of these categories, which is number one, the plant or equipment is sold, transferred, or repurposed for non-gas utilization within the 5 years of purchase. So you've purchased this equipment for gas utilization, and then you are not using it for the purpose of gas utilization. Maybe you're using it for something else, or you just purchased it for nothing. I don't know about it. So you have to show evidence when you want to claim for this. You have to show evidence. Records will have to be there for you to be able to claim it. Otherwise, if you cannot prove that you've actually used this or that you've sold it or transferred it to another person, you are going to be able to claim this. And the second one is that the expenditure was made under an artificial or non-bona fide business transaction. A lot of companies engage in what we call fictitious transactions, where you purchase an asset and then sell it to yourself, basically. You have a subsidiary. So you purchase it and then you sell it to your other subsidiary, or you just purchase it for other purposes that are not exactly what you're supposed to be using to do with it. So if it's an artificial or non-bona fide business transaction, maybe you're using it to cover up or to front for another business, then you are not going to be able to claim this. And also, if you acquired it solely for resale, because some companies also do this, where they acquire a product or an equipment and then resell it, and then in trying to file for their taxes, they want to claim the cost of acquiring that as an expense, which defeats the purpose of the law, because the law wants to be able to shield you from the expenses that you've made for the purpose of running the business. So if you've purchased it and then you sold or transferred or leased it to another person immediately, it means you're no longer using it for your company. It's no longer an operational expense for you because you've gotten your money back already and you've sold it. So if you had acquired this solely for that purpose, then you can't take advantage of this. And also, if a company sells or transfers an asset that has already benefited from the incentive, the new owner cannot claim the allowance gain again. This is very important because, especially for this kind of equipment that are very, very expensive. Recently, we were advising a German client who wanted to deploy a technology, a machinery for gas utilization, gas commercialization, basically in Nigeria. And this equipment is about $10 million. So you can understand that a lot of companies who want to acquire or purchase some of this equipment may not be able to acquire it as a first-hand value. So you're acquiring something that has already been bought over or have passed through different sale values, different parties, different companies. It's part of your job now to do the due diligence if you really want to take advantage of the gas incentive. Because if you acquire something that, as of the time that it was acquired, maybe 5, 6, 7 years ago, it claimed these tax incentives. And if you acquire it, you will not be able to claim it again because this allowance has already been taken under the initial sale of the property. Then the third one, under the same oil and gas companies tax incentives order, is incentive for deep water oil and gas projects. Now, this is a fiscal incentive that was introduced by the government to, achieve a competitive internal rate of return, and really, really limited to companies who are in the deep water oil and gas projects. I've, in a nutshell, tried to explain the incentives that are applicable for NAG, for onshore, NAG onshore and shallow water assets, midstream and then, but this is for deep water oil and gas, E&P companies. So this particular incentives now for deep water oil and gas incentives apply to both existing, that's your brownfield projects, and then new greenfield projects in deep water fields as well. As an offshoot to this, there was a notice, because if you look at the order just made like a visionary statement about this particular incentive, now giving powers to the minister to issue a subsequent or subsidiary regulation that will break down the eligibility criteria, the implementation order, and then other relevant provisions on how companies in the deep water oil and gas projects, that's your E&P or core E&P companies in the deep water assets, can take advantage of these incentives. And I'm going to explain that on another slide because it's more elaborate. So now, it's a summary of the implications of the orders that I have mentioned. The opportunities for NAG development is number one. So if you're a company venturing into NAG exploration and development, particularly in a greenfield project, greenfield onshore and shallow water, you can benefit from the gas tax credit. And that will reduce your tax burden, that goes without saying, also allowing you for greater financial flexibility to reinvest in your gas field growth. However, it's important that you meet the conditions set by the order. What we do from time to time in our firm as lawyers is that we have some clients who come into the country and also existing clients who are E&P or other operators in the oil and gas value chain ask us to give them a memo, an advisory memo on the tax incentives that apply to them. We do that from time to time. So we basically highlight what they can do, starting from the general one, which is your pioneer status incentives and every other relevant incentives that has been given by this order. So we provide that and break it down for you, and then also giving you some of implementation guidelines that you should be able to implement from a compliance perspective for you to be able to qualify for the incentives. So that's one thing that we do. Companies must meet the conditions set by the order, such as maintaining your HCl, as your hydrocarbon liquid content, between 30 and 100 barrels per million SCF to qualify either for the $1 or 50-cent tax credit. And also there's the ability to carry forward any surplus GTC for up to 3 years. So that provides you a valuable cash flow buffer. And also your midstream gas utilization investment allowance, which I just spoke about. So companies who are in the midstream and oil and gas infrastructure, and such as your gas processing or transportation facilities, you will benefit from this tax relief on your plant and equipment purchase. And then the third one, which I'm still going to talk about, is companies considering deep water oil and gas exploration. You will find the fiscal incentives aimed at improving your IRR financially attractive. This is the first simulation on the summary. It was necessary to give like a summary of this or this first, and then we can delve into it because some of them are a bit technical. Now, this is a practical example that we have here, a simulation. So the Falcon Energy Limited, which is a Nigerian oil and gas company, is non-existent. So what I've tried to do for all these relevant models was to do like, we've prepared like a simulation exercise so that you can relate to what we're talking about. So Falcon Energy Limited, a Nigerian oil and gas company, is planning to develop a new greenfield NAG project in an onshore location. And the project is expected to produce its first gas by 2028 with a HCl content of 25 barrels per million SCF. Based on the order, Falcon Energy can potentially benefit from the fiscal incentives as follows. The number one is your GTC. So since the HCl content is below 30 barrels, it's a no-brainer. You qualify for the full tax credit of $1 per 1,000 SCF. And if my math is correct, if the company produces up to 200 million SCF of gas daily, it can claim up to 200,000 in tax credits per day. And that significantly reduces your tax obligation over the 10-year period. The second one, which is the midstream investment allowance, still under this simulation. So beyond NAG, Falcon Energy also plans to invest in a gas processing plant to refine and distribute its extracted gas. Under this executive order, it can claim a 25 gas utilization investment allowance. Remember that there's a cap of the utilization investment allowance you can claim as a midstream company. So you can claim that and allowance on your capital expenditure for plant and equipment, of course, reducing your taxable income and increasing your profitability. Then the third one, which I would lay more emphasis as we go on. So in the future, if Falcon Energy decides to expand into deep water oil and gas projects, the fiscal incentives under the order will improve the financial viability of the operations. Now, after the order was issued sometime in February 2024, there were implementation guidelines issued by the Minister of Finance in respect of the order, basically setting out the application and structure and eligibility criteria, breaking them down for ease. The implementation guidelines apply to, first of all, companies holding licenses or leases engaged in NAG. So you have to be a company operating, holding a license, a company that is eligible to operate in the sector in the first place. It's just like your SITA as well. You can't claim your company's income tax if you're not a company incorporated and doing business in Nigeria. Now, the second one, which is the midstream gas companies carrying out gas utilization projects. So under the implementation guidelines, you have the FI, that's the Federal Land Revenue Service guideline on the applicability of tax credits and allowance for non-associated gas greenfield development. Then you have your FIRS guideline on the applicability of the midstream capital gas utilization allowance. And then the third one is the NUPRC guideline on hydrocarbon liquid content in a non-associated gas field. So what that NUPRC guideline did is to give the technical requirements and sort of set out how to determine, how to measure hydrocarbon liquid content in NAG. That's purely an engineering and technical thing, but yes, the guideline provides some guidance on how to arrive at that and how to do the right measurements. So the first one, which is the FIRS guideline on the applicability of tax credit and allowance. Now, what I'm going to be saying now on this implementation guidelines is just at the back of what I had just explained. The first one was the order. So after the order, usually in your executive orders, there will be provisions where the government, the president will give an order to the relevant ministry or the relevant regulatory agency which oversees activities in that sector for which the order was issued, to go ahead and implement guidelines, to issue guidelines which makes it clearer, which provides clearer, more detailed, more robust provisions on how the provisions in the orders will apply, to whom it applies to, and every other relevant thing. Now, under the implementation guidelines, for you to qualify for NAG, you must have had a valid license or lease and must have achieved first production on or before January 2029. where you have achieved your first gas production after 1st January 2029, you will be entitled to a gas tax allowance rather than a GTC. And I think all of these things here, where your HCl content is between 0 to 30 barrels, the GTC rate is lower than 1,000. I've talked about all of these things. So the guideline is just a repetition, but a more detailed, the implementation guideline is a more detailed repetition and a breakdown of how to achieve the incentive in the other. And I also talked about your rollover of gas tax credit. So if it's granted to an eligible company and it exceeds your CIT, you can roll it over for up to 3 years more. And anything after 3 years more will be forfeited. Then also the second one, which is on the midstream, this is the implementation guideline now, not the other. Just like that of the NAG development, for you to be eligible for your utilization allowance, you must possess the relevant licenses issued by the NMDPRA, which is the regulatory agency in charge of midstream and downstream. And you must have incurred a qualifying capital expenditure on your plant and equipment in one or more of the following gas operations. So what this now does is that it tells you kind of midstream gas operations that you must have engaged in for you to be able to claim and say, yes, I incurred this expense in this plant and machinery, and therefore I'm entitled to the allowance. So the first one is transportation of natural gas to gas conditioning and processing plants. Transportation of natural gas from gas conditioning and processing plants to gas-based industries and other end-use customers, but specifically not exceeding exit points, connecting gas distribution pipelines and network. And also your gas processing plants. The first one is natural gas. This one is just your gas processing and conditioning plants. Also your gas bulk storage infrastructure. So if you incur expenses in purchasing plant and machinery in any of these activities, including your gas bulk storage infrastructure, then you will be able to claim for that. Now, a bit of clarity on what your qualifying expenditure and qualifying plant and equipment means. So these are like your tangible assets and any other company that make up a plant or equipment that is used for gas processing and transportation in midstream gas operations. Then, provided that the useful life of the asset is beyond the period of 1 year. So if you buy an asset that is completely useless or not able to function in less than 1 year, or then within or less than 1 year, then you will not be able to claim for your investment allowance. Then these are the conditions for you to be able to claim for this as a midstream company. The cost of the qualifying plant and equipment must have been incurred by the company from the commencement of the order, and then the company must also show proof of ownership and the evidence of the direct use of the plant and equipment for gas processing and transportation in midstream operations. And then I've also mentioned this restriction that applies in 39(1) of the CETA. So, which is that you can only claim this after your tax-free period in CETA. Now, under your NUPRC implementation guidelines for determining hydrocarbon liquid content in a NAG, the guidelines try to establish a framework for assessing what your HCl content in NAG fields and reservoirs are, and then they also apply to all greenfield license holders and lessees involved in natural gas production. So the measurement guidelines under this NUPRC guidelines require that natural gas liquids be measured using a dynamic method, except where the NUPRC grants approval for a static measurement approach. I mentioned earlier that this is pure engineering, and I would assume that the engineers in the room understand how these measurements and the equipment and the relevant technology you use to determine that. So that's basically it on the order and the implementation guidelines. And then you have the notice, because I mentioned at the beginning that all these incentives apply to the different sectors, relevant sectors in the value chain. So here where you have notice of tax incentives on deep offshore oil and gas production, what's your order? The order did not really provide anything apart from a visionary statement on how the ministry will go ahead to issue other subsidiary legislations to, basically set out what the incentives are for the deep offshore oil and gas production. Now, what this notice does is to provide clarity, set out provisions, and that will make the E&P companies in this deep offshore projects, oil and gas projects, be able to claim those fiscal incentives. So the eligibility conditions, the number one is that the OMLs and the PMLs that operate must be operating under PSCs, that's your production sharing contracts or profit sharing contracts, to be able to claim this fiscal incentives. And then also your existing OMLs and PMLs with an approved field development plan, where the lessee makes a final investment decision between the effective date, that was 2024, when the order was issued, and then between that and then January 1st, 2029. So what this means in a nutshell or in simple terms is that both OMLs and PMLs holder, you know that under the PIA, you have your PML, and then under the old Petroleum Act, you had your OML. So the existing OMLs then that have not converted, we still call them OMLs, and then some PMLs, you still call them OMLs, just used interchangeably. So your OMLs and PMLs that have an approved field development plan, you must have an approved field development plan, and you must have made your final investment decision. Your final investment decision is where you have agreed commercially, technically, financially, that you are ready to take on this E&P project. Your financiers are ready, your company has signed off on that, and you cannot go back to say that you can't commence. So it's basically like an ascertainment that this project is going to take place. That's your FID. So you must have had your FID and your field development plan. That's for your existing OMLs and PMLs. And then for future leases, so any leases awarded after the effective date, including those arising from both existing and future oil prospecting licenses, or PPLs, that's your petroleum prospecting licenses. So that means that the current holders of OMLs and PMLs in the deep offshore who make FID between last year when the order was issued and 2029 will qualify for production tax credit. So while you call the other one gas tax credit under your NAG, for this deep offshore, you call it a production tax credit. So for existing leases, your lessees are allowed to apply for an extension if they are unable to meet with the FID deadline, maybe if there is a force majeure event, or if there's a conflict with the community that makes it unable for a lessee to apply for the production tax credit to make a final investment decision before January 1st, 2029. So if you are in this deep offshore operations, and you would or you've just been awarded a lease or a license, as the case may be, to either prospect or to mine oil in a deep offshore area, then you have between now and 2029. And if you're unable to get to your FID between then, you can also apply to the commission, that's the NUPRC, setting out the reasons why you're unable to meet up with that, and then they can give you some concessionary extension of timeline for that. Now, the calculation for incentive, we've done the calculation for GTA and investment allowance with the caps and how that would apply. What I have on the screen now is how to qualify for your production tax credits as an E&P company in the deep offshore zone. So if you have a producible reserves of oil that is 400 million barrels or less than that, you are going to qualify for $3 per barrel or 20% of fiscal oil price. I'd mentioned before that your fiscal oil price or your fiscal gas price are all tied to your calculation of your royalty rates in the Petroleum Industry Act. So whichever is lower, right? Whichever is lower but cannot be less than 150 million barrels of production. But if your barrels is more than 400 million, then you have $4.50 per barrel or 20% of your fiscal oil price. Whichever is lower is what you are going to be claiming for that. Now, your future leases awarded after the effective date qualify for an additional tax credit of $1 per barrel up until 500 million barrels. And then also, if crude oil price fall below $50 per barrel, then your production tax credit applies at a reduced rate of 50%. So if the price of crude is $50, it falls below $50 per barrel, then if you had a producible reserves of about 400 million barrels or less, then instead of having the eligibility to claim for $3 per barrel or 20% of the fiscal oil price, what you'll be claiming would be $1.5, and that's $1.50 or 10% of your fiscal oil price, as well as if it's above 400 million barrels, but the price of oil is below $50. What you're going to be claiming would be $2.5 cents per barrel or 10% of fiscal oil price, whichever is lower, up to 500 million. So it's about it. Then incentives for I've talked about this before. These are your incentives. I just put them both on the screen so that you're looking at it and you can tell the difference between your oil and gas production in deep offshore and then your NAG calculation. I've talked about all these things before and why your incentives are important. Your production cost management, utilization of surplus tax credits. So you can carry forward, just like you can do for your GTA under NAG, where you can carry forward for any surplus GT or unused gas tax credit for a maximum of 3 years. Under your deep offshore oil and gas operations, you are able to carry forward any surplus production tax credits from a given year for up to 3 years as well. And so this allows you to maximize your tax benefits over time. And then also, there's a cost management framework that encourages you to adhere to a cost limit set by the commission. If your unit technical, that's your unit technical cost is your technical operating expenses and all of that. So if the sum of that exceeds the benchmark cost determined by the commission, then your applicable tax credits will be reduced by 10% as well. I've already talked about. Okay, so this is supposed to be like a distinction between your production allowance and your production tax credit. So your notice, that's the notice for deep offshore oil and gas production. It prohibits operators from claiming both production allowance and production tax credit in the same tax year. So you have to choose one incentive per year, depending on which option better aligns with your optimization strategy. And I've already talked about FID and investment decisions. So it's also important for you to finalize your commercial decisions internally so that you're able to claim that before 2029 as well. And where, for reasons for force majeure, because the law, the executive order and implementation guidelines was very strict when it says that you can only claim for an extension of time if you're not able to achieve that. If your inability to achieve the FID at that 2029 is due to a force majeure. So if it's for another reason that is not force majeure, then I'm afraid you may have to lose out from that. Now, this practical example, the practical example for me, it's the most critical part of all these things, because most of what I've been saying is may sound a little bit overreaching, or you may find some of them not very clear, and then also sound like they are similar, but that's how the law provides for it, and it actually works. But when you pay attention to the practical example, you will see how it's able to drill down on your day-to-day operations as a company in the deep offshore assets. So FEG Energy Limited, which is another simulation, a deep offshore oil and gas operator, secured a petroleum mining lease in March 2024 for a field with 450 million barrels of crude oil reserves and a 2 TCF of non-associated gas. Now, the company made its final decision in June 2024 and notified the commission within 30 days. Application of this following tax incentives will accrue to the company. The first one will be your crude oil tax credit. So since FEG Energy's reserves exceed 400 million barrels, they qualify for a $4.50 cents per barrel tax credit, right? Up to 500 million barrels of production. So once it's above 500 million barrels, you won't be able to claim that. So, but if crude oil prices drop below $50 per barrel, the tax credit will reduce to 2.25 per barrel. I had given that example before on the preceding slides. And the second one is your gas production tax credit. Your NAG, which we had explained before. So the FEG snag has a HCl content of 25 barrels per SCF. So this qualifies them already for the $1 per MSCF tax credit, up to 5 TCF of gas. Once it's above 5, you can't be able to claim anymore. Then your unit technical cost compliance is also part of the important provisions that the notice makes, which is that your unit technical cost, FEG's unit technical cost is $18 per barrel of oil equivalent. That's your BOE, below the $20 per barrel of oil equivalent benchmark, meaning that you receive your full tax credit without the 10% reduction. Now, remember that I said that where your unit technical cost is above the benchmark, all your tax credit is going to be reduced, right, by 10%. However, the unit technical cost, that's your production cost, your production and processing cost is $18 per barrel, and the benchmark is $20, then you are going to receive your full tax credits, and vice versa if it's above that. And then also carry forward of surplus tax credits. Now, if FEG Energy does not fully utilize its tax credits in 2024, they can carry them forward for up to three years. Now, the last order, which is very important, which is a VAT modification order, which was also issued last year, 2024. Now, the VAT order seeks to amend the existing VAT Act that we have. And then under the new order, you have the following items. So what the VAT order did was to include, extend or expand the list of items which are previously exempt from VAT. And then, so under the VAT order now, the following items are now exempt from VAT: equipment and infrastructure for CNG and LPG expansion, including your conversion kits. So if you are paying for your for equipment or infrastructure, whether you are if you're buying, whether you are importing or selling to another party, as the case may be, equipment or infrastructure for CNG and LPG expansion, including your commission, you're supposed to pay VAT on that. So if anybody is issuing an invoice and putting VAT there, it's totally wrong, and you should be able to contest that. Also, your domestic LNG processing facilities and equipment, no VAT. Electric vehicles, very important, and also parts for the assembly. So the components of the for assembling electric vehicles, people in the power sector do this a lot, where they import components and then assemble them here, and then some of them also have to buy from different other suppliers to assemble them. So your electric vehicles, as you're selling them, or the parts that you're using for their assembly, whichever case, is exempted from VAT. Also, your biogas and biofuel equipment for clean cooking and transportation. Now, another important thing that the order did, the VAT modification did, was to provide a new definition of petroleum product which expands the previously exempt items to now include feed gas for all processed gas. So your feed gas for all processed gas, your automotive gas oil, that's your AGO, your compressed natural gas, your CNG, or imported LPG, they are all now exempt from VAT. And I think that's, for me, was one of the highlights of last year's VAT, because we have a lot of importation and exportation and buy and selling of CNG, and also with the new initiative to convert vehicles to CNG, and also a lot of activities happening in the natural gas sector. So we have all these items now exempt from VAT, which significantly reduces your burden as an operator. Also, so I mentioned the products that are exempt now. There are also services exempt from VAT as well. So your CNG conversion, so your LPG conversion and installation services, your CNG conversion and installation services, and then your manufacturing, assembly, and sale of electric vehicles, they are all exempt from VAT. So this VMO, that's the VAT modification order, really underscores the Nigerian government's drive to stimulate economic growth, and then, through fiscally environmental responsible tax laws, and also aligns with the government's long-term goal of achieving net zero emission by 2050. I don't know how, if that is far-fetched or if that's going to be possible, but yes, nothing is impossible, but it's all part of that bigger plan, that bigger vision to achieve net zero by 2050, and to incentivize people in the sector in the activities that, basically help to make the environment safer and promote green operations. So all of these things, I've mentioned them before. You already know what the implications are for you. Your expanded opportunities, your lower capital expenditure on equipment procurement, reduced operating costs. I always look forward to, as a business executive, as a business owner as well, I look forward to always ensuring that, I claim all reasonable claimables and deductibles under the law, because that helps me have more liquidity for business. If I have to pay so much in tax, then how do I run my business? So it's very important, very, very important for us to, pay attention to this. And I'm happy the slides are going to be shared after the class so that you can go through it. And if you have any further questions on that, you can always, you can reach out, or you can also ask them here, depending on whether we have the timing for that. So it's really very important. And then also, apart from the VAT modification order, there's also the deduction of tax at source withholding regulations 2024. So under this withholding tax regulations, some products were exempted from WHT obligations, and that's your LPG, compressed natural gas, premium motor spirit, automotive gas oil, low power fuel, your jet fuel, your dual purpose kerosene. So these exemptions are intended to reduce the tax burden on companies involved in the supply and distribution of all these items mentioned here. And then that's about it for the first one. For the first module on tax incentives, I don't know if I should quickly delve into the second module before the questions.
Yes, please. Go ahead.
Okay. Now, the second one, and I'm going to be very quicker here, is navigating host community development. It's very important, and not just a regulatory footnote. It's very important because we want to show that we care for our communities, and also we more importantly, we don't want to attract so much heavy penalties for failure to comply with the provisions of the PIA on ensuring that we comply with this host community development framework. Also, it's when you as a company in the oil and gas sector, when you are looking for funding for your oil and gas projects, when you are looking for financing, especially from the international community, they look at these things because they are your ESG metrics. They are your ESG compliance metrics. They want to know how far you have gone in keeping to the standards, how far you have gone in trying to comply with the provisions of the law. So it's extremely important to understand the framework of host community development. So the objectives of Host Community Development Trust is to foster sustainable prosperity within host communities, to provide direct social and economic benefits from petroleum operations to host communities, enhance peaceful and harmonious coexistence between licensees and lessees and host communities, and also to create a framework to support the development of host communities. Under the PIA, the Nigerian government introduced, several legal and policy reforms culminating in the enactment of that act. And one of that is, of course, the HCDT. That's what I will call it throughout this session. So basically transitioning community engagement from a discretionary corporate social responsibility initiative to a legally mandated structure that you have to comply with. Generally, in Nigeria, the legal framework governing host community engagement derives from number one, Petroleum Industry Act, because that's actually what applies to you as members of NAPE, as professionals and as business people in the E&P sector. And then pursuant to that PIA, which enacted the provisions, there was an upstream petroleum host community development regulations in 2022 issued by the NUPRC. And then the midstream, that's the NMDPRA, also introduced regulations. And then, of course, you have your Nigerian Oil and Gas Industry Content Development Act that has some provisions, your EIA, Environmental Impact Assessment Act, and Land Use Act 1978. But our focus will be on the PIA. Now, under the PIA, all holders of PPLs, that's your petroleum prospecting licenses, PMLs, that's your petroleum mining leases, and other petroleum titles are required to establish a HCDT for their host communities. That's the community where they're operating. And then this trusts must be incorporated as legal entities. So you are going to be setting them up as a company, but of course, like an incorporated trustee. And then you're subject to oversight by the NUPRC to ensure compliance with the law. Mandatory financial contributions for the HCDT is that a petroleum operator engaged in E&P is obligated to contribute your 3% of your actual annual operating expenditure, that's your OPEX, from the preceding financial year to the HCDT. So every year you're supposed to contribute 3% of your OPEX from the preceding year, right? So if your OPEX for the preceding year is let's say 200 million or 500 million naira, you're supposed to contribute 3% of that, because taking care of the community, ensuring that they are safe, warding off conflicts and all of that should count as your expenditure as well. So you should think about that. So you will take 3% of that amount of your OPEX in the preceding year and then put it into the trust fund. So, and it is strictly, that money is not to be touched for any other reason apart from community development initiatives. It can't also be diverted for other business operations. So this, if you look on the chart, you will see the allocation and utilization of the trust fund, which derives from 244 of the PIA. So that 3% that goes into the HCDT, 75% of it will be for capital projects, including infrastructure, healthcare, education, and economic empowerment initiatives for the community. Then 20% will be allocated to a reserve fund. Is reserved, so you're not using it for your capital projects or for your expenses for the community. So it's basically to provide for a long-term financial sustainability of the trust, just in case you need to draw on it for any reason that is not tied to capital project, but basically just to ensure that there's something there all the time. And then 5% of that 3% will be for administrative expenses, covering the operational costs of the trust. You can see that in the chart here. So every trust fund, every host community development trust operates under a structured governance system comprising 3 key bodies. So you have your board of trustees, responsible for managing the trust funds, approving budgets, and ensuring regulatory compliance. Just like you have your board of directors in a company. And then your management committee, it's more like the executive arm of the trust fund. And so what they do is to ensure that the projects that have been approved for the community are, implemented, and then they prepare financial reports, and then they serve as a liaison between the company and the host communities. And then there's the advisory committee, which represents community interests. So they're going to have like chief representative from the community as well. And then they are the ones that do a level of monitoring, identifying priority developments to ensure that the company achieves the implementation of that. Now, key parties, these are the relevant parties. If you're developing a framework, because there has to be a framework really for a company in the EMP sector. So if you want to develop a framework for this, which is mandatory, by the way, these are the parties that you have to ensure are represented in the framework. Number one, of course, you as the settler, goes without saying. And then your, of course, the trust fund itself, which is the corporate body that will be established. So the beneficiaries will be the host communities, and then the board of trustees, which I've mentioned, the management committee, the advisory committee, commission, or the authority, which is regulatory bodies responsible for overseeing the implementation. So this is the regulatory oversight provided by either by the NUPRC to ensure that you are complying with the provisions of with your policy, your community development policy. And then there's a fund manager appointed by the board to manage the reserve fund for the HCDT. And then, so the settlor's obligations as a licensee, as a lessee, you have the responsibility to incorporate the HCDT, and there are timelines for that, which I'm going to explain further. So for existing leases under the PIA, you must establish the trust within 12 months from the passage of the PIA already. So I want to believe that almost all the companies here already have their HCDT in place. Then your annual contribution, which I've mentioned, and then your needs assessment, which is conducting an assessment of host communities to determine social, environmental, and economic needs. Under this needs assessment, you are required to involve the community representatives properly, because they are typically the ones who know their pressure points in the community, where they are lacking, their deficiencies, and will now be able to, give you that information for you to be able to develop a plan on how to develop the community. So you have a development plan. So you have to, this is also a plan that you have to submit to the NUPRC, and I'll talk about that. Also, you have a matrix for fund distribution. You have to provide a framework for equitable allocation of trust fund to the host communities, when, how, and for what. And also appointment of your trustee. So it's your job as a settler, which is your job as the lessee, to appoint these trustees and communities and committees. Now, the functions of the board of trustees obligations. The first one is fund management. So you are allocating, so they're going to be working hand in hand with the fund manager here, who basically will ensure that the funds are safe and allocated properly for what they have been earmarked for. So I've already mentioned that 75% is for capital projects, 20% for reserves, and up to 5% for admin costs. Then they also provide project oversight, because they are the directors, they're on the board. The people who are really invested with implementing projects is the management committee, which is the executive arm. And then also, I've talked about here, budget preparation, contractor selection, that's your management work. Then host communities, advisory committees, obligations, you have to nominate community members to the management committee, and also the community members who are going to be in the advisory committee as well. And then tracking and reporting projects, security and peace building. Basically, they are part and parcel of the framework that you're going to be setting out. Now, so in incorporating the trust, which is where it's very important to pay attention. So the trust is to be incorporated within the timeline stated in section 236 of the Act. As the PIN, I said that is 12 months from the effective date. For companies who are already have existing licenses or leases, so it means that so if you are already have an existing license or lease, under the PIA by now, you should have incorporated your HCCC. So you're expected to have a meeting with the communities, and based on the outcome of the meeting, you're supposed to conduct a name availability check with the CAC, and they're just the same way, the same procedure you use in incorporating a company. So, however, at the beginning, I had mentioned that this is like an incorporated trustee because of the nature of purpose of the fund. So you're not setting up a company that will run an operation or for something else. It's basically just to be a trust company to ensure that the funds are being used for what they have been created, earmarked for. And then I don't want to go into all of this because this is just the procedural process for setting up a company under the CAC. And then we go to the needs assessment / development plan and fund distribution metrics. So under section 251 of the Act, the settlor is mandated to carry out a needs assessment, and each needs assessment is to do the following from a social, environmental, and economic perspective. You're supposed to determine the specific needs of the community. I've talked about this, and you can't do that without involving the community. So there has to be a rep there that you have to work together with. Also ascertain the effect that the proposed operations might have on the host communities, just like when you're doing your environmental impact assessment, and then provide a strategy for addressing the identified needs and effects. And then more precisely, the needs assessment is to require an evaluation of the level of primary, secondary, and tertiary education in the community. So these are the things that your needs assessment is supposed to have. And needs assessment is very important. Like it's clearly stated that you have to have that. You have to have that particular document that creates and sorts out the needs assessment of that community. So you need to know what's the level of primary, secondary, and tertiary education in the community, the availability of basic utilities. Is there water? Is there lights? Is there a public playground? And is there a public restroom for the community? Your access to healthcare, the level of infrastructural development in the community, or social economic. And so it's just to, like you're doing your DD basically to check the loopholes and issues in the community. And then other needs that you think are relevant, apart from the information that you also get from the community's representatives. So I've already mentioned that you're supposed to engage the host communities. The key thing here is basically engagement to understand where the issues are. And then you need to have so it's from this needs assessment, right, that you have to create, that you now develop what is called the host communities development plan. Now, it's very important to have your needs assessment in place because that's what you use to create your HCDP, which you are going to have to submit to the commission, the NUPRC, and it's a mandatory requirement. So you have to prepare and submit to the host communities development plan to the commission for approval within 30 days after incorporation. So again, I would assume that for companies who have been existing, that this are already done or in place. So once approved, it cannot be amended without the commission's prior written approval. So your HCDP, which is your plan, will outline your initiatives and strategies from the needs assessment, which you must have done, and will specify the projects for implementation with a timeline, and also set objectives and justifications for each project, and then also align with Nigerian content requirements, provide for ongoing review and reporting. Now, the HCDP spans 5 years and is evaluated annually. So your plan that you're going to be developing will be a 5-year plan with a flexibility to evaluate it annually, just as the situation deserves. Now, the upstream regulations for 2022 provide for what we call a fund distribution matrix. And this usually is just to issue a template to guide settlers in preparing the fund metrics. However, the matrix is presently required to set out some basic details, which is your basis for fund allocation to communities, your details of existing community support programs, any additional requirements. For me, I think that this is too overlapping because in my opinion, this is a personal opinion now, you have your host community development plan, which should, by and large contain all the other requirements, including the fund distribution matrix and everything. So that's about that. And then administration of the trust. The settlor bears the duty of establishing the host community development trust. I've already talked about that, and I've mentioned the parties who are required to do the different obligations. And then it's very important to talk about the accounts relating to the trust fund. So the trust fund is to be deposited in a designated account with a commercial bank in Nigeria with a minimum credit rating of BBB issued by 2 rating agencies. And then the board of the trustees of the fund will then maintain in the same commercial bank 4 separate accounts, and the funds in each are not to be commingled. So the accounts to be maintained by the board. So you have your collection account, which is your primary account where your contributions, your 3% contribution goes into. And you have your capital fund account. So all those allocation of funds, right? Because I mentioned that there's a 75%, there's a 20%, and then there's a 5%, which is your capital reserve and administrative cost, respectively. So you have that in different accounts because it can be, if you commingle, it will be different to allocate which particular fund has been earmarked for a particular thing altogether. And this is supposed to be a very transparent process. So you have those 3 allocations in 3 different accounts, and then you now have your collection account itself, which is where your contributions to the host community will be domiciled. So initial and annual contribution, these are your financial, I'm almost done, please indulge me. So your settlers' financial contributions and obligations, your initial annual contribution, which I've talked about, which is at 3%, your previous contributions for ongoing host community projects will count towards your first annual contribution. So if it is less than 3% of your settlers' operating expenditure, then the shortfall must be paid. So, for instance, if you're making a contribution between 2021 to 2022 to an ongoing host community project, right, that should count. If you have been doing that before setting up your host community development fund, then that should count into the 3% that which will be your initial deposit into that amount. So when you calculate your ongoing project costs and expenses in the year before, and to be able to commit that into your current account, and if it's less than 3%, then you have to pay the shortfall. And then contributions for your previous years, it does not count for previous for future contributions. And then your 3% operating cost is also calculated separately for each area of operation. So if you have like different communities or different fields situated in different communities, so your 3% operating cost will be calculated separately for each area. You cannot merge your operating cost from a particular field to another field. There has to be like 3% each from all those different area of operation, because those areas, I mean, it goes without saying, they have different communities attached to them. And then the OPEX, I've talked about this, fund management and for future clause. This is very important now for future clause. So when host communities are hostile and there is civil unrest, and then the sabotage clauses, they sabotage your infrastructure. So if you are going to be using your money to repair the items or the infrastructure, has been vandalized, it goes without saying that they shouldn't be entitled to the development funds. So if vandalism and civil unrest causes damage to the extent of repair of those costs, they will not be entitled. So if I use 2% or 2.5% out of the 3% to repay what they have done, then they are only going to be getting 0.5% of the trust. And if I use the entire 3% to repay what they've done, then they will clearly forfeit everything. Now, your reporting obligations are important because this is the monitoring measure that the NAPE-SB has put in place. You have to render quarterly returns to the commission in relation to the fund and provide the details. And then you're also to submit to the NAPE-SB your mid-year and annual year reports. It's just a reporting requirement really prepared by your management committee after 30 days of submission. And then your settlor is to submit an annual report of your activities and audited accounts of the trust no later than 31st May of the following year. So there are 3 reporting obligations here. There's a quarterly returns. There's also a mid-year and annual reports by your management committee, and then there's an annual report of activities, financial statements and audited accounts and all that. Now, as to the deadline, which is also a very important part of this, so that you know where you fall into as whether as a company in the E&P sector if you don't have this trust fund set up yet. Now, so Section 236 of the Act provides that within 12 months, the deadline for existing oil mining leases is 12 months, and then from the effective date of the lease. Also, for existing other designated facilities, also 12 months from the effective date of operation. Also, for new designated facilities under constructions, still 12 months, basically 12 months from your effective date of the mining lease, or first month, 12 months from your date of commercial operations if you have a designated facility under construction that is not exactly a lease. And then, so prior to the application of, so the trust will be incorporated prior to the application for field development plan for existing oil prospecting licenses. So if you have a PPL, as the case may be under the new PIA, you have to have, before you even apply for submit your field development plan to the NAPE-SB, you must have incorporated the trust, because that's part of what you are going to be imputing in the document. And then also prior to the application for any field development plan under a PPL or PML, you have to have that. And then if prior to the commencement of commercial operations for licenses of designated facilities granted under the Act, so if you are a new licensee or a new lessee, as the case may be, before you commence commercial operations, then you need to have your trusts incorporated. So this applies to companies who are getting licenses after the PIA, and then new companies in the E&P sector who of course fall under this compliance obligation. So before you start your commercial operations, you need to have incorporated that trust. And then, so if you apply, you have to apply to the commission for approval to incorporate the trust, and the application for approval is sent by a letter that you're going to send to the NAPE-SB no later than 60 days before the deadline for incorporating the trust. So you have 12 months already, which is like the deadline between which you have to do that. And you must have sent your application 60 days before that deadline, because the commission will need their time to review your application and then be able to grant you the approval. This is also another timeline for doing your needs assessment. You have to do that within 6 months following the grant of the lease or license. So if you get your license, you have to do the needs assessment, and then within 6 months to understand the community that you're engaging in. Disputes resolution, and then penalties. Now, so for parties who are disputing, you have to attempt to resolve your issues amicably. This is usually the structure that we use for agreement as lawyers. There's always a provision that parties should try. And so you have to engage with the community where there are issues. And if it's unresolved, the disputes will be referred to the ADR Center of the Nigerian Oil and Gas Center for Mediation. And then, which I think it's in Lagos, the former DPR office. And then the commission intervention, if the mediation and ADR center, which is now set up, which is run by the NAPE-SB as case may be now, fails, then you have to escalate it to the commission. And then where the commission fails to resolve the matter, then you can go full-blown arbitration under the Arbitration and Conciliation Act. If you fail to incorporate the host communities development trust fund within the timelines that are set by the law, you pay a penalty of about $2,500 per day, or the Naira equivalent from the expiration of the commission's 45 days notice until incorporation. So when you apply to the commission, usually you have a 45-day approval period within which to incorporate the company. So, and remember that you have to apply within 60 days before the deadline, before the 12 months deadline. So that 45-day period is extremely important. So at the expiration of that, you have to be incurring $2,500 per day. And then also, I talked about a quarterly return, which is to be filed by the management on the more like a progress or monitoring report on the activities of the HCDT. So if you don't do that, you pay a $10,000 penalty and an additional $1,000 per day for continued default. And then there is also other penalties here. So for instance, if you fail to remove a disqualified trustee, there are certain provisions that under the law that you have to, for instance, you can't appoint somebody who is just like appointing your directors. You can't appoint somebody who is of an unsound mind or somebody who has been convicted to be a trustee. So if you fail to comply with these things or to fail to remove a trustee who has been disqualified by virtue of those prohibiting restrictive provisions, then you will be paying $2,500 a day as well. And then failure to conduct your needs assessment, your development, your host communities plan, and then your fund distribution matrix, your penalty is $20,000 for failure, an additional $1,000 per day. Now, in practice, I wouldn't know because my experience with some in the oil and gas sector is that some of these penalties, I mean, lots of companies who haven't done this and who are still in the process of doing it, and they're racking up the penalties, and some are able to, shield cater to these penalties for some time. But the reality is that there's also another provision where the NUPRC can revoke your license for a prolonged default. So you don't want to get to that because you cannot, the penalty, generally should not exceed like $250,000. So when you now exceed that $250,000, what happens? So it's either the commission makes a recommendation to the minister that your license be revoked, right? Or you start having issues with the regulators and having other activities approved and all of that. So there are also other, I don't want to read out this thing for the want of time, but there are also other provisions here that attract penalties under the provision and under your compliance and engagement with the host community. So if all the directives of the commission, if you fail to remit funds, if you fail to discharge your obligations, if you make false or inaccurate, incomplete, misleading, any record or report, so all these things, there are penalties accruing to that. What I would advise, or what we have, some requests we've gotten in the past is, basically to have like a policy. Companies usually have like compliance officers who help to work up a document to prepare a framework that has all these provisions that timelines, the things that are required to be done and all of that. So the lawyers can help you prepare that. Either your in-house counsel or your compliance counsel can help you prepare that so that from time to time, you have a document that you can refer to, right? Because the provisions are all over, they're scattered all over the PIA, and it's not efficient for you. So it's basically to have a document that you know that this is your framework. This is when you're expected to deliver on this needs assessment. This is when you're supposed to do this. This is the quarterly report and everything to ensure that you do that from time to time. Now, this is a simulation exercise as well. So Ozan Energy Limited, an independent oil and gas company, operates an oil mining lease in the Niger Delta. And under the PIA, it must incorporate a host communities development trust within 12 months of the effective date of the lease. Now, however, due to internal administrative delays and in challenges in community negotiation, Ozan fails to incorporate the trust within the deadline. Now, there's a compliance issue here already. So after the 12 months deadline, that's 12 months from the effective date of the lease, the NUPRC will issue you a 45 days notice to demand your compliance, and then you continue to delay beyond the notice period. Then the consequences is that you are fined $2,500 a day. Like I mentioned, there's a risk of license revocation, which I've talked about before. And then also revocation, which NUPRC will have to escalate the matter to the minister and then recommend that you be revoked. And then there are other remedial actions that you can do. So to avoid this, what you would do is to engage a legal advisory firm to fast track, first of all, the trust incorporation, because you have to incorporate the company, hold meetings with host communities, and then submit the necessary documents to the CAC and the NUPRC or field development plan and all of that. So the key takeaways here is that it's critical to avoid financial penalties and operational risk, and your delays in compliance can affect investor confidence and your regulatory relationship, which you don't want. And then also early engagement with host communities and regulatory bodies is essential to meeting your obligations under the PIA as well. So I think that this would be all. There are other simulation examples here which are similar but with different regulatory requirements, but I think I've explained what the basic requirements are, and that I should probably stop here because I've been talking for over an hour, way above my time, and I don't want to lose the crowd so much.
Well done. Can we all please give our speaker a virtual clap? I don't want it to stop because you're almost there. You're just about 3 or 4 slides away from the end. However, our time is fast spent already. So we're diving into the Q&A. I've taken time to collate all the questions that were sent in using the Q&A tab and the chat box, and I've passed them on to you. Ozioma, can you please confirm that you have the questions already?
I'm seeing a number of questions. Are there specific ones that you've sent to me?
No, I collated them on a Word document and I've passed them on to you. So you probably need to check your inbox directly. I think I asked Caller Joe to just send it to you. However, I could read them out. We will not take all the questions, right? We'll basically just take about 3 questions because our time is fast spent already. So in an order of priority and all that, a lot of the question we're asking, can we get slides? Can we get all of that? The answer is yes, the Secretariat will make that arrangement. And this session is on YouTube Live on NAPE YouTube handle. So you can always make reference to it. All the participants, okay? You can always make reference to that. It's there for you. But for the slides, that will come on a later date. So quickly, do you want to pick or shall I read the 3 questions to you, Ozioma?
Yes, please, you can read.
Okay. Now, the first question is from Julius Adeso. there appears to be some ambiguity regarding the application of deep water incentives. Can you confirm whether this incentive applies to both PSC and PSC or sole rigs license holders, or are they strictly limited to PSC parties? That's the first question. And then also the second part of the same question is, please, does the executive order apply to existing brownfield with NAG production, or it just greenfield with first NAG production before January 1st, 2029? So that's the first question. Will you want to respond to this before the next?
Yes, please.
Quickly.
Thank you, Julius. So the first one, you said whether the incentives apply to both PSC and PSC sole risk license holder, or are they strictly limited to PSC? So it's to PSC parties. And then you asked whether the executive order applied to existing brownfield. No. For NAG, it's only to with respect to greenfield NAG projects. So it has to be greenfield NAG projects, and it's for production before January 1st, 2029.
All right, good. Now, the second question is the choice between production allowance and production tax credit in any given year to be made at the start or at the end of the year? Also, that's the question, please. That's the first part of the question. I won't take the second part. The next question is the computation of benchmark unit technical cost defined or fixed, and can it be reasonably anticipated? Please respond to this. Hello, Ozioma.
Yes, so I will start with the second one, which is a computation of benchmark unit technical defined and fixed, and can it be reasonably? So yes, it's defined. I think I defined that when I was making the presentation. That's your BOE, that's your barrel production cost. And it's fixed actually, but I will have to check the guidelines. I would have to check that there's an implementation guideline very different from these orders that I've just explained. But yes, it's defined and it's per barrel. It's your cost, is your production cost per barrel, and it's fixed.
Okay. Now, there are a whole lot of more questions that come in. I'll take this one and let's see how it goes. Does the restriction or combining this tax credit with the associated gas framework agreement incentive mean that the companies must choose one incentive over the other? That's the first part. And the second part is that the requirement that non-associated gas, that's greenfield project, must achieve first gas production or on before 2029 to qualify them for the full gas tax credit. Does this create a time constraint that may pressure companies to accelerate development, potentially leading to compromises in safety, environmental standards, or project quality? Over to you, Ozioma.
Yeah, so I think the first question, if you don't mind, can you take the first question again? The second one is a bit too long, so I couldn't grasp all that, but the first.
Okay. Does the restriction on combining this tax credit with the associated gas framework agreement incentive mean that the company must choose one incentive over the other?
So it depends on the activities of the company, So when I was explaining, there are different incentives for different companies. So if I know that there are some companies who have an E&P arm, right? And then at the same time also have a midstream. So it depends on the activity. And the distinction is very clear. For instance, if you are a company that is involved in NAG, in a greenfield project for your onshore and shallow water assets, then you can claim your GTC, that's your gas tax credit.
Yeah.
And then at the same time, if you cannot claim it after you have a maximum of 3 years to carry it over, right? And then also at the same time, you have your investment, your GTA. So after your 3 years, your GTC becomes a GTA, which you can use for a maximum of 10 years as well. So it really, they are different, right? And it's not, you're not limited. It really depends, it's what your internal tax person, your internal tax official can help you compute or compile together, but they are different and they have different regimes for that. There are also different timelines, right? Your midstream, for instance, you have a 25% and it distinguishes it from the, you have a 25% for your qualifying expenditure, and then it's different from your capital allowance that's already in the SITA in any case. So they are different. They are not the same, basically. And also depends on the activities that you're doing.
Okay. I won't be doing any more further questions. All other questions, we'll collate them.
Do you
Yes, sir.
Do you mind taking one of the hands up? Maybe just to get a voice in. I think I see some hands up. Maybe we can take one up.
Okay, I have 2 hands up.
Hello, can you hear me?
Yes,
we can hear you.
All right. Good afternoon, everyone. Thank you,
Good
Madam
afternoon.
Ozioma, for spending your holiday with us and also clarifying some of these complicated tax incentives. My first question is around your statement around combining ACFA with the fiscal incentives. And does that mean that a project, for example, that has been benefiting from ACFA, maybe because of the start date is prior to the 1st January 2029, then now converts to PIA and wants to benefit from the gas tax credit and also maybe gas tax allowance? Does that mean that you can combine both during the lifetime of a field? Then the second question is around the GUIA. You said something around the fact that you can claim 25% of capital allowances, and that does not exempt you from the original capital allowance claims that companies typically make for capital expenditures. That seems like double dipping to me. Am I correct in my thinking? If that's the case, man, maybe I need to go and set up my own midstream company to benefit from all this. Thank you. On a lighter note.
Yeah. All right, Ozioma, you want to respond to this?
Yes, please. So I'll start with the second one. So if you check, and I wish I had my slides open to show you the actual difference. So if you
should I
check
stop
to
sharing?
yes.
Okay.
Let me just take him back to the slides.
Over to you.
So if you check the provisions of the SITA, right? First of all, there is for companies in the midstream sector, you have a tax-free holiday of 3 years, and after that, an additional 2 years. That's number one. And then as an alternative to that, you have a capital allowance, right? That gives you a 35% of the capital allowance. And also another alternative that gives you an investment allowance in the same SITA of 90% with 10% retention. Now, the provision of the GUIA, that's your investment allowance, already it gives you that 25%, right, which you can claim for a maximum period of 10 years. So what it does is that, first of all, it does not preclude you from claiming your investment allowance on the SITA, but it precludes you from claiming your capital allowance on the SITA. Your capital allowance is 35%. But what the order says is that if you are claiming your investment allowance under the GUIA, the implementation, the executive order and the implementation order and all of that, it does not preclude you from claiming the investment allowance, but it precludes you from claiming the capital allowance. So there are 2 different allowances on the SITA. However, all these allowances, right, for you to be able to claim your investment allowance, there must be an elapsed period. You must have the tax-free period that you have under the SITA as a company in the midstream unit must have elapsed. So that 5 years, first of all, must have finished before we now talk about your investment allowance, which is 25. So after your 5 years, you have a 25% allowance, which you can take for an additional period of 10 years, which does not preclude you from the investment allowance that you are entitled to under SITA. I don't know if I'm making any sense.
Yeah, you did. You did. All right. Let's take one more question, please, Ozioma, if you don't mind, on host on HCDT, okay? On host community. So there's a question here that says, can a company claim loss of production? Sorry. These are coming so quickly, yeah? Can a company claim lost production hours due to community unrest against the HCDT fund in terms of loss of production volume? I think that's no brainer. Go ahead. And then it will take okay, there's no other hand up. So please just respond to this and let's see how it goes.
Can a company claim
Can
loss
a
of what
company
exactly?
claim lost production
Of course.
hours
Of,
due to community unrest against the host community development fund in terms of
yeah.
lost production volumes?
Yeah. Yes, basically. So if when I was talking about that part where the more hostile a community is, the less likely they're going to get development, is because the vandalism, the destruction of infrastructure will all go into the expenditure of the company. So and it's already like it's a provision in the law. It's very clear that when a community is not compliant, not cooperating, and they vandalize the projects and infrastructure, then you as a company can, file that notice to the regulators, and you're able to claim it, right? You're able to set it out and basically say that you don't have any the expenses that you have used to reposition the infrastructure that has been destroyed. You cannot, you can claim that basically, and then say that you've used the money that you're supposed to have deposited, right? Remember, you're supposed to deposit like 3% of your expenses into that this thing. So, and so you can claim it basically and say that you've used that 3% to restructure what has been spoiled, and therefore you don't have any money left to develop the community. You don't even have to go that mile to explain. Once there is evidence of destruction and uncooperation and vandalism, then a community, the law uses the word forfeit, will forfeit the development plans for the time period. And of course, if there's dispute, everything will have to be put on hold until parties come together. Put on hold from the end of the community anyways, in terms of development plans. So everything will have to be put on hold until there is a resolution of that, and parties are able to agree to work together if they do.
All right, thank you. There's no any more hand up, and I think I've read most of the questions. We yield the mic to P, to the president, and then he will round up. Please, guys, if you're on this call, this is just a teaser, right? There's a whole lot more coming in during the summer school. But again, I'm sure P is going to talk about that. P, I yield the mic to you.
No, thank you very much. And thank you so much, AIC. And a very big thank you, Ozioma Agu, for this excellent revelations and commercial mindsets that you've kind of brought into this community. As you know, we are really professional, technical, but also we're also business minded. So really want to say very, very big thank you for taking your time to go through the series of. It's one thing for the president to give the directives, which we already practice in anyway, but I think the second thing is for us to really understand what those directives are. And I think you've done justice to all the 3 executive orders that were given last year. And by the way, it's not just about giving those executive orders. We're already seeing the impact in terms of the progress we're making in oil and gas industry. So a very big thank you, but also the HCDT element which you covered is pretty quite good that we operate in a sustainable manner and efficiently within the communities where we operate our assets. So a very big thing. You can see the applause coming. So it's quite good. So I will also appeal to the Assistant Editor-in-Chief and the Public Secretary. Some of the questions, if there's anyone, please let's collect them and send to Ozioma, and then she can answer offline. I believe she can. And like you said, there is going to be more of this coming during the summer school, both technical leadership and commercial. So a very big thank you once more to yourself. And if you look at the audience, we've been able to hold roughly about 100. Amongst them, senior professionals in our association. I see the advisory council chairman was on the call, a lot of fellows and a lot of executive and members across both Nigeria and out of the country. That shows you the interest. And for us in NAPE, we'll continue to do this. It's not just about technical, but also the commercial platform to discuss the business, how to bring value to the country, to the companies, but also ultimately to ourselves. And for those that want to venture into owning some assets as well. So on that note, I want to say thank you to everybody and thanks for the organizers for this session. And I think AIC, do we still have another slot for them to speak, or this should be it? Just double checking.
No, they should be able to give a comment, please. Stren and Blan, give a comment.
Okay, please.
Yeah.
So let's hear more from you, Stren and Blan. I don't know if it's Ozioma, are you speaking or?
Sorry, yeah. Is there any specific thing you want me to say?
Oh, okay. Yes, maybe about your establishment, or maybe one more final words.
Okay, great. So hi everyone once again, and thank you. I'm a bit thirsty. I want to drink water because I've been talking. I'm a partner of Energy, Finance and Infrastructure at Stren and Blan Partners. We're a full service commercial law firm headquartered in Lagos, Nigeria, but we have branches in Abuja and Enugu as well, and we work across Nigeria and across Africa. We are we are very commercially driven. We are very commercial savvy. And I don't want to start sounding like I'm doing a pitch for you, but I just want to say thank you to NAPE for bringing us on board to do this thing. This is what we do for our clients. Some of them actually on a value add basis where we don't necessarily have to even quote them, but because of the relationship that we have, we are always giving advisory opinions for clients in the energy sector, ranging from oil and gas to power. We have a tax team anyway, separate from me in the firm, dedicated basically just for tax, tax advisory. But as it pertains to oil and gas and energy, I also oversee that. So we look forward to more collaborations with you. We look forward to more engagements with you. There are other plans to, like even physically engage and other things that we can offer as a value to NAPE as an organization. We appreciate what you do, and we appreciate the opportunity for both organizations to collaborate. We look forward to more of that. And if you have any we advise clients in the oil and gas sector. We also help to sort of connect clients in the value chain. From time to time, we get requests from investors in the oil and gas sector asking for questions, asking for companies who may want to get some funding or who may need some services. I traveled for the Africa Oil Week last year, and I was able to network with a lot of companies who are looking to do something in Nigeria and Africa as a whole. So we have such contacts in our database as well, and it's important that we have this collaboration with you so that if we have such requests that will benefit members of NAPE, we'll just pass it across to the right channel through John Bosco and other executive as the case may be. So yeah, I believe there's so much that we can do together to help you both commercially and also legal wise. But thank you very much.
Yeah. No, thanks. Thanks, Ozioma and your team. And again, thanks to all the audience that has stayed back up until this moment. Enjoy the remaining part of the holiday. Eid Mubarak. Thank you very much.
Thank you, P. Thank you. Thank you, P. Thank you, everyone.
Thank you.
Awesome. Awesome.
Thank you very much.
Yeah,
awesome.
Excellent.
Thank you. Bye.